Ever just sat there, watching a fortune literally evaporate in real time? There's this visceral, stomach-dropping tension that grips the whole world when the stock market suddenly goes into freefall. You know the feeling. It's not just numbers ticking red on a screen, right? It's the collective panic of millions of investors realizing that the wealth they thought was totally secure is just vanishing. Welcome to The Explainer. Today we're going to unpack the cinematic and honestly sometimes terrifying reality of why markets actually crash. We're going to strip away all the dense financial jargon and look directly at the hidden forces that cause the global financial world to just catch fire. Okay, let's dive right into this. To truly understand a crash, we have to start with a foundational question. What actually happens when the market just breaks? You see, we often think of the market as this perfectly rational scale, constantly weighing the value of companies based on their earnings and growth. But here's the thing. A market crash isn't about rational valuation at all. It's actually a structural failure in the financial plumbing. It's this wild moment when the basic laws of supply and demand are violently overridden by raw human psychology and a desperate, desperate need for cash. Negative 55.25%. Let that sink in for a second. That is exactly how much the S&P 500, which is essentially a collection of the greatest companies in America, plummeted during the 2008 global financial crisis, from its peak in late 2007 all the way down to its trough in March 2009. We're talking about over half of the market's value just wiped out. So we're not talking about a gentle, everyday correction here. We are talking about a systemic, Category 5 economic storm. To survive a storm like that, you really have to understand how it forms in the first place. So let's move into Section 1, Anatomy of a Crash, Structural Failures. This is where we dissect the chain reactions that physically force asset prices straight down. Official macroeconomic data actually categorizes market panics into a taxonomy of financial runs. Think of a run kind of like a frantic dash for the exits in a crowded, burning theater. First, you've got credit-driven runs, which are sparked by a specific failure, like a bad mortgage security. Then you have liquidity-driven runs, where short-term funding completely freezes up and investors start panicking that their money is going to be locked up. Speculative runs are fueled purely by rumors and a lack of transparency. And then the absolute most dangerous one is the firestorm run. That's a sudden, absolute dash for cash at any price that can literally overwhelm clearinghouses and trading systems in a matter of hours. And that dash for cash, it creates a mechanical nightmare. The SEC actually describes this perfectly. They note that intermediaries in need of liquidity must dispose of assets at fire sale prices, which ends up creating a downward spiral. So the absolutely crucial point here is that during a crash, massive institutions like hedge funds aren't just selling the bad assets they want to get rid of, because honestly, nobody's buying them anyway. Instead, they're forced to sell their absolute best, highest quality assets just to raise cash. This floods the market with massive sell orders, driving prices down even further, which triggers more margin calls and forces even more selling. It's just a vicious, self-reinforcing loop of total destruction. But you know, a crash doesn't just happen out of nowhere. It needs fuel. Which brings us to Section 2, Bubbles and Irrational Exuberance, the setup for a crash. We really have to look at that deceptive calm right before the storm hits. This psychological state right here is the ultimate setup for a crash, irrational exuberance. It happens when times are so good for so long that investors just forget risk even exists. They start extrapolating positive trends indefinitely into the future. They bid up equity prices way, way beyond what actual corporate cash flows can justify. And honestly, worst of all, they borrow heavily to do it. As the fear of risk completely vanishes and complacency takes the wheel, the entire financial system becomes incredibly fragile. And look, this is absolutely not a new phenomenon. We saw it centuries ago with the famous Dutch tulip bubble. We saw it in 1929 when massive leverage pushed valuations to absolute extremes. Fast forward to the late 1990s, the dot-com boom pushed stock prices to astronomical heights compared to actual, real corporate earnings. And we've seen it recently too, right? With the post-pandemic exuberance surrounding the generative AI investment boom. Broad-based euphoria built up incredible, intense pressure in the financial atmosphere, leaving the entire market totally exposed to a sudden shock. So, when the system is absolutely bloated with exuberance and leverage, all it takes is one little spark. That brings us to Section 3, Rates and Inflation, Triggers of a Crash. Arguably the most powerful force in the entire financial universe is the federal funds rate. When inflation starts running hot, central banks like the Federal Reserve are forced to step in and raise interest rates. Now, higher rates make borrowing expensive, which naturally slows down economic growth. But mathematically speaking, a higher federal funds rate also increases what's called the discount factor. This means investors suddenly demand much higher returns to justify the risk of actually holding stocks. So the very moment rates go up, the present value of stocks is instantly repriced downward. It's cold, it's mechanical, and it happens fast. But how do we know when this medicine is going to choke the economy? Well, the bond market has this ultimate warning siren: the yield curve inversion. When the yield on a short-term 3-month Treasury bill actually rises higher than a 10-year Treasury note, the market is practically screaming that a severe slowdown is coming. Historically, this specific inversion gives an average lead time of 48 weeks, so about 11 months, before a technical recession officially hits. It is a massive, glowing red flag that the atmospheric pressure has officially shifted. Okay, so we know the mechanics, we know the setup, we know the triggers. Now let's move to Section 4, a history of panic, contextualizing chaos, just to see how these theories actually play out in the real world. Looking across the last century, a really fascinating truth emerges. The catalysts, they change every single time. In 1929, it was systemic leverage. In 2000, it was the bursting of the massive tech bubble. In 2008, it was those infamous subprime mortgages. In 2020, a completely unexpected global pandemic. And in the 2025 and 2026 data we analyzed, we saw massive market shocks triggered by sudden global tariffs and complex geopolitical conflicts. But here's the kicker. While the spark is always totally unique, the structural underlying pattern of human panic remains exactly identical. Let's actually zoom in on October 19, 1987, Black Monday, for a perfect example of this. The S&P 500 plummeted roughly 20% in a single day. Why? Well, it was a lethal combination of new technology and old-fashioned herd mentality. Institutions were using these computer-driven portfolio insurance models that were designed to automatically sell futures when prices dropped. So when a totally separate catalyst triggered some early selling, these computers just blindly executed massive sell orders, which drove prices even lower, triggering even more algorithmic selling. The volume literally overwhelmed the trading systems, completely breaking the market's infrastructure. So, how does it all stop? How do we prevent a total apocalyptic economic collapse? This is exactly where the Federal Reserve steps in as the ultimate structural safeguard. Historical Federal Reserve records show a highly coordinated 3-step playbook to unfreeze the plumbing. First, they make high-profile public statements to calm market sentiment. Second, they inject massive, immediate liquidity into the system, literally providing the exact cash that institutions are desperately scrambling for. And third, they highly encourage banks to keep extending credit flexibly so the broader economy doesn't just suffocate. Now, the government can step in and save the broader system, but they can't magically save individual portfolios from taking a huge hit. Knowing that another crash is quite literally always somewhere on the horizon, we reach Section 5, Surviving the Storm, the Rational Rebuild. To really survive, you have to fundamentally change your mindset. BlackRock draws a really hard, distinct line between gambling and investing here. Gambling is just hoping for a quick win on the next spin of the wheel, which is honestly exactly what the herd is doing during a period of irrational exuberance. But true investing? That's recognizing that markets will inevitably hit what they call air pockets, those terrifying sudden drops. A real investor focuses on owning assets that can generate solid cash flow right through those air pockets, using a long time horizon to let compounding do the heavy lifting. And this brings us to one of the most brilliant philosophies in finance, championed by Benjamin Graham and famously utilized by Warren Buffett. It goes like this. A $10 bill purchased for $5 at a time of great fear is a bargain, even if fear grows and the price goes down to $2. So the absolute crucial takeaway here is this. When the market breaks, it operates purely on blind emotion. It indiscriminately crushes the prices of bad companies and great companies alike. For a rational, long-term investor, a crash isn't a disaster at all. It's a rare, incredible opportunity to buy remarkably high-quality assets at a massive, massive discount.
So let's summarize your actual blueprint for the next financial storm. Let's call it the rational rebuild. First, long before the crash even happens, build a risk-appropriate, diversified plan and actually stick to it. Second, when the firestorm hits, whatever you do not panic sell into a downward spiral. Third, use the chaos to buy anti-fragile businesses. These are companies with massive economic moats that will survive pretty much any recession. And finally, trust the process. Trust that while the market is completely and utterly irrational in the short term, Mr. Market eventually returns to his senses and prices solid, cash-flowing businesses rationally.
Because look, the next market crash, it's not a matter of if, it's entirely a matter of when. The plumbing is going to jam, the herd is going to panic, and the red numbers are definitely going to dominate the screens again. But armed with a real understanding of the mechanics, the psychology, and the history we've explored today, you absolutely do not have to be a victim of that panic. I'll leave you with this final thought. When those sirens start blaring again, will you see the next market crash as a total disaster or as the absolute greatest buying opportunity of a lifetime? Thanks so much for joining me on The Explainer. Until next time, stay curious and stay focused.